just realize that if you do a Roth conversion the same year you're doing capital gains, it's going to kind of mess up that strategy.
Dear YMYW team, this is Danny Noonan writing in from St. Paul, Minnesota. All right, well, Minnesotan. Danny Noonan. Danny Noonan is, right?
Yeah, Caddyshack, right?
You got it. I discovered your podcast early this year, and now I can't miss an episode. Listening to the new episode is one of my highlights each week. Danny, get a life.
Or we could say thank you for your compliment.
Go back to the golf course. Yeah. My wife, Lacy Underall, you know who she is. You remember her on the Caddyshack?
Yeah, Caddyshack also. Is that the younger gal?
Yeah.
Yep.
It was Snails, Judge Snails' niece.
Let me think about that one. Okay.
Lacy
I'm
and I are both 51 and getting close to retirement. All right. We began investing at a young age, and we're looking forward to enjoying the fruits of our labor. Lacy has $1.2 million in her current 401k, as well as two others with a total of $300,000. We also have a Roth IRA totaling $280,000. I have 1.2 in my 457 plan, which I can start withdrawing at 55. I like how they help us with the rules.
That's right. Yeah. In case we don't know.
Just in case, he's probably listened to the show once or twice, right? 312 in Roth accounts. Is going to have a pension around $66,000 starting the year at age 66. We also have about $900,000 in various brokerage accounts, $300,000 in cash. We anticipate taking Social Security at 70 with the combined benefit of $70,000 per year. My target retirement is 55. We anticipate spending about $120,000 a year. All right, so you add up all those assets now?
I did $4.5 million.
Okay, 4.5, and then he's 120 to 4.5.
Yeah. So at age 55, we would think of maybe a 3% distribution. Let's see, 3% of 4 million is 120. Add another, 135. Yeah, no problem.
He's close.
Yep.
Although we are close to retirement, I still have a few years to be fully vested in the pension program. One option we are considering is to have Lacy retire at the end of the year. We have always filed our taxes jointly, but if Lacy is not working, do we have this big opportunity here? I know where he's going with this.
Yeah, me too.
Yeah. Since I will be working next year, I anticipate earning $165,000, which would have us paying capital gains tax. Okay. Why would he be paying capital gains tax?
I think you have to read the next sentence.
As part of our brokerage accounts, Lacy is heavily weighted in Company X stock, $272K from employer stock purchase plan and $320,000 in restricted stock units, which are fully invested and have had the taxes paid. The company stock has done wonderful over the last few years and is at an all-time high, far different from the rest of the market. I know it is risky to have so much in one stock. If we file separately and Lacy has no income next year, would this allow her to sell all this company stock with no capital gains? Could she also convert about $53,000 to a Roth IRA? Does she need to be 59 and a half before she can start converting her IRAs to Roths? Danny.
Okay, a lot of questions there.
Danny.
Some got derailed a little bit there.
Settle down here, Danny. All right. Well, let's just kind of
let's
burst this bubble real quick.
Yeah, let's start there. So, well, first of all, Lacy has restricted stock. I assume that's what it's worth. You don't pay tax on what it's worth. You pay tax on the gain. So when it was not restricted stock, right, then you pay tax on that. Whatever it was worth at that point is your tax.
Whenever it was vested.
That's your tax basis. Okay. So in other words, 272,000 of employee stock purchase plans. Let's just say it was worth 172,000 at the time it vested. So that means you got 100,000 gain, right? It's not the whole amount. So you got to figure out what your gain is, not the value. And yes, you pay capital gains on that gain. If Lacy files separate, and that's fine as long as Minnesota is not a community property state, which I don't think it is. California is. I'm very familiar with that. So if she could file separate, that means the top of the 12% bracket is about 42,000. Right, 42,000, you add the 12% standard deduction. So in other words, she could have about $53,000 of gains and pay no tax. Once she goes over that dollar amount, the gains are taxed at 15%, right? And if she goes over 200 some thousand, 215,000, that's taxed at 20%. The capital gain rate is taxed at 20%. So anyway, I think if I'm understanding the question, a lot of people think that I'm in the 10% bracket, so I can have as many capital gains as I want. I pay no tax. And no, you pay zero capital gains to get you to the top of that 12% bracket.
So you're saying if he's married, she's got a lot of capital gains.
Yeah, so she can file married filing separate as long as it's a non-community property state. This could work.
So it's like, okay, well, here you're going to have a lot of income, but then that income is my income is ordinary, and your income is capital.
Yeah, or zero until you do something.
Right, until you make the transaction.
Right.
File separately. She sells the stock. She could get a favorable tax rate because if they file jointly and he's making 165,000, that could bump them up. Depending on what the gain is.
Right. And you and I don't talk about that much because California, this doesn't work at all, because community property state means whatever I have, half of that's mine and half of that's yours, and vice versa. Whatever you have, half is mine, half's yours. So it just doesn't work.
Right.
That's why it doesn't come up much for our clients.
So in Minnesota, you would have to, I don't know, maybe Andy does a little research here.
Yeah, I'm pretty sure it's not a community property state, because there's only like 10 or 11.
Yeah, I think you're right. It isn't.
It's mostly West Coast states, it seems. So then to make matters worse, if you throw a Roth conversion on top of that, it just keeps adding to that taxable income. So now all of a sudden, less of your capital gains are going to be taxed at zero, because now you got ordinary income to boot.
Yep.
Confirming Minnesota is equitable distribution. It is not community property.
Okay. That's right.
There you go, Danny. And then you do not have to be 59 and a half to do a Roth conversion.
That's true too.
You can do a Roth conversion at any age. Unless you pay the tax from the IRA as you convert it, there would be a 10% penalty on whatever you take out of the IRA to pay the tax. So just pay the tax outside of the IRA and you're fine. You can do the conversion there. So to continue on here, we're going to blow up the clock.
Okay.
It seems like anything beyond 53,000 level would put her in the 15% tax rate on all her capital gains going forward for the next couple of years. Would it make sense for us to file taxes separately until I retire as well, given the anticipated tax rate starting in 2026? I know we should start converting to the 24% tax bracket and possibly to the top of the 32 while we know the tax rates are certain. I believe our goal is to convert as much as we can by age 63, so our RMDs will never put us to 182,000 IRMAA limit in the future. Am I missing anything? No, Danny, you're dialed.
Yeah, just realize that if you do a Roth conversion the same year you're doing capital gains, it's going to kind of mess up that strategy.
If filing jointly, will the combination of the earned income and Roth conversions over the 250 trigger additional 3.8% NIIT tax? Yes, net investment income tax. Because the cap gains sit on top of ordinary income. In the Roth conversions, ordinary income, and your cap gains sit on top of that. And if that pushes you over the limit for net investment income tax, then anything over that limit will be subject to the other 3.8% tax.
Yeah, and married filing separately, once you're over 125,000 of modified adjusted gross income, you got to pay that net investment income tax.
Okay. So let's see, if Lacy retires next year, maybe all brokerage assets should be sold to avoid these additional taxes. Yeah, I think we answered that. I would appreciate your spitball on our situation and provide any optimization. Wow.
Okay.
We're not doing some optimization here. We're just throwing out ideas on the back of a napkin. I always thought investing the money into various retirement accounts was the difficult part. Now I realize how important it is to have an exit plan to keep as much as possible. Thanks for all your contributions to financial literacy. All right. Well, thank you, Danny Noonan.
Are you prepared for retirement? Schedule a free financial assessment with an experienced financial professional right online at purefinancial.com.